In this part 2 video lecture for chapter 5, let's go over some temporary book to tax differences. On this slide, what we're looking at is a taxpayer corporation investing in another business, another corporation. In all situations, when a taxpayer receives dividends from another corporation, for tax purposes, you report that as dividend income. Now, there is a related dividend received deduction for tax purposes that we'll see at the end of this second slideshow, this part 2 slideshow. But in all situations, we're looking at taxable dividends being reported on the return, all dividends. Now, for financial statement purposes, if you own less than 20% of that invested company, any increase or decrease in the value of that investment, here is called unrealized gain or loss, has to be reported on the income statement. But for tax purposes, you don't report gain or loss, like we learned a couple chapters ago, until the gain is realized. Then you report it or recognize the gain or loss. So this is just a temporary difference. You're reporting the gain or loss now for financial purposes, even though you didn't sell the stock, and you adjust the investment downwards for the dividend received on the financial statement. Again, for tax purposes, you just report the dividend income and ignore this unrealized gain or loss. Now, if the amount of the investment is more than 20% but less than 50%, if you remember in your maybe intermediate accounting class, or definitely the advanced accounting class, you learn something called the equity method, where the investor reports their share of the invested company's income or loss on their income statement, and again reducing the investment by the dividend received. For tax purposes, you ignore that adjustment and you just report the dividend income. Again, this is a temporary difference until eventually the stock is sold or the investment is eliminated. The third situation is when the investing company owns more than 50% of the investee. So here we're looking at a consolidated financial statement. But for tax purposes, you still prepare separate returns for each business, and you report dividend income being received from one corporation to another. This third situation is where now you could elect to consolidate the corporations together into preparing one 1120, one corporate tax return. This is an election. It's not mandatory like for financial purposes. But if you don't make this election, you still report under this rule for financial, consolidated financial reporting, and you still report the dividend received by that parent corporation. Our textbook here in chapter 5 does talk a little bit about filing a consolidated return. So we're kind of just glancing over that in our chapter, this lecture. Again, it's an election. Usually you would do it if one corporation in the affiliated group has a loss, and that can be used by offsetting the income of another corporation in that same affiliated group. Otherwise, you would have to wait and use the loss and carry it over to a future year of that loss corporation. Okay, so that's one timing difference. Again, everything would even out in the long run eventually when the investee corporation is sold or it's get rid of by our taxpayer parent corporation. Here we have an example of a situation where we have a parent PCC that owns 30%, again, which is more than that 20 we saw in an example in the previous slide, of a sub called BCS. And during the year, BCS paid a dividend of $40,000. So you know that's going to be reported on PCC's income tax return. But because it's more than 20%, PCC is going to report 30% of BCS's income, which is 100,000, on their income statement. Okay, so that's $30,000, which is less than the dividend being paid. So 30,000 is going to be reported on PCC's income statement for their investment in BCS. And on the tax return, PCC will report 40,000 of dividend income, $10,000 more. Because you're paying or reporting more income on the tax return than the income statement, 10,000 more, this is an unfavorable difference, a temporary one. Eventually they will even out when PCC sells their investment or gets rid of their investment in BCS. Here's the actual calculation. Again, the dividend that you have to report on the tax return compared to the income you're reporting on the income statement, which is PCC's interest in the subsidiary's income. And because it's $10,000 more on the tax return, it's an unfavorable and it's going to be a temporary difference. The next type of temporary difference is for interest being deducted. In the case of the income statement, we just deduct all of the interest expense, but there's a limitation on the tax return. The limitation is that you cannot deduct more than 30% of the taxpayer's taxable income. That's adjusted for not taking any, reporting any interest income or interest deduction. Okay, so 30% of this amount is the maximum you can deduct in any 1 year. Now this rule applies to relatively large corporations, where here it says the average gross receipts is 25 million, more than 25 million. Here is a temporary difference, maybe even a permanent difference, that's in your homework problem about stock options. There's two categories of stock options, one called incentive stock options and the other called non-qualified stock options. Of the two, the non-qualified is more popular. In both cases, incentive stock options and non-qualified stock options, for income, for financial purposes, financial statement purposes, we're going to deduct something called the fair value of the stock options over the period in which the employees earn this option, these stock options, over the period in which they get vested the right to eventually buy the shares at hopefully a lower price versus the higher value in the future. And it's the same for both stock incentive options and non-qualified stock options. So we just kind of determine the value when these options are given at the very beginning, and we amortize that cost over so many years in which the employees earn the right to eventually exercise the options. And in both cases, for tax purposes on the tax return, there is no deduction over this period in which the employees get vested their stock options. Here it says at the very end, though, only when the employees buy their shares, exercise the options to buy it hopefully at, again, that cheap price versus the future higher value. Only then that the extra value gets to be deducted on the tax return. And nothing really extra here except, again, the amortization of that fair value at the very beginning. So in the years over which you amortize that value, it's going to be an unfavorable difference on the tax return, because you have to back out that deduction. You cannot deduct it on the tax return, where it is being deducted on the income statement. But now when you exercise that option in that future years, there's going to be a favorable uh, deduction, favorable difference on the tax return. Here they call it a bargain element. Again, that's the difference between the value of the stock at that future date minus how much the employees have to pay for that shares of stock. That was already set many years ago, typically. Now, you have to compare that that bargain element to all of the past years' amortization of that value of the options being deducted. If the bargain element is bigger than all those past years, the extra bargain element is going to be treated as a permanent favorable difference because you get to deduct now more on the tax return as compared to all the previous years on the income statement. But if all of the previous years amortization of that fair value of the option is larger than what's being deducted here as the bargain element in the year the stock is exercised, the option is exercised, the excess of this over the bargain element is going to be an unfavorable, is it here, unfavorable permanent difference. So one of these two is going to be showing up in your homework exercise. Let's see if we can take a look at some examples here. So we have on the beginning of the year, 2018, PCC grants 20,000 non-qualified options. Remember, that's the more popular of the two types. And the value of each option is $5. That's how much you think it's worth just to receive this option. So 20 times 5 gives us the total value. So here's the cost that on the income statement is going to be deducted over the period in which the employees earn the right to get vested. So we're told here they have to pay $15 eventually for each share. So that's why the employees want to work hard for the company so the share price increases in value as compared to the amount they have to pay, this $15. So it's going to be exercisable after just 1 year, kind of short. Here they call it vesting, right? So after 1 year passes by, now the employees can exercise all 20,000 options, buying shares at $15 each. So the question though is, what is the book to tax difference at the end of the year, that first year? And all of the 100,000 is used up by the end of that first year. So on the income statement, you're going to deduct 100,000 for the stock option expense. Whereas on the tax return, there is no deduction. Again, you get the deduction eventually when the option is exercised. And in this case, it's not yet, not exercised. Okay, so 100,000 unfavorable difference. And it's temporary because we're just waiting now eventually for the options to be exercised where the difference will reverse. So continuing with the same example, then 2 months later, the employees exercise their options, all of it, buying their shares for $20 each, keeping in mind they have to pay $15, right? That was the exercise price. It's valued at 20, so the difference is that same $5 value they had determined over a year ago. So the question is now, what's the favorable unfavorable difference? Again, because the difference is this $5, that's the bargain element. That's the amount they can deduct for all 20,000 shares. So 20 times 5 is that 100,000, and it's being deducted on the tax return. Favorable, yeah, offsetting the previous year's unfavorable difference. Again, favorable difference this year, and it is temporary because it offsets the previous year's unfavorable. difference. Let's change the facts. Instead of that $20 exercise price, $20 fair market price, it's now worth $24. Remember, they're still paying $15 a share. So the difference here is $9 more, and the value that was being used over the past year was that 5. So now the extra is $4 more of value that's going to be deducted. Okay, so because there's a bigger deduction, we know the difference is going to be a favorable difference. Um, let's see the calculation here. So here's how much is that favorable difference. If you remember the $9 times the 20,000 options equals $180 of deduction. Still zero deduction on the income statement here in 2019, but $180 deduction on the tax return. Keeping in mind, you already reported 100,000 a deduction on the income statement last year. So you're offsetting that, leaving you another 80,000 to be deducted. And because there's nothing to offset on the income statement, 80,000 is treated as permanent difference. The 100,000 that was reversed from last year is a temporary difference. Both are favorable because you're deducting it on the income statement, the tax return now, and nothing now this year for the income statement. Let's move on to another temporary difference, and that's capital losses. If you remember a couple chapters ago, to get a capital gain or loss, you have to dispose of capital assets. So if you have more capital losses than capital gains, the end result is you have a net loss, a net capital loss. And you cannot use net capital losses to offset other income of the company. Now, if you were an individual like you or me, we can use net capital losses up to $3,000 each year to offset other income. And then we would just carry forward the loss to future years. In the case of corporations, none of that capital loss can be used to offset any ordinary income. But you can take that extra net capital loss and carry it back 3 years ago. So in our case, if this net capital loss happened in 2018, you can carry it back. Here, the loss is 2018. You can carry it back to 2015 to offset any capital gains in that year, or 2016 or 2017. If you still have extra net capital losses, you carry it forward five more years, 2019 and so forth. And if you cannot use it within that 5-year period, any net capital losses for 2018 will expire unused. It's wasted. Yeah. In the case of income statement, you just deduct the loss on the income statement. Again, in this case of a tax return, they're limited. You get to use capital losses only to the extent of gains, capital gains. Let's look at net operating losses. I'll tell you what, before taking a look at net operating loss, let's kind of compare NOLs, net operating losses, with net capital losses. Let's try a black screen here. And if you remember, the general rule was revenue or income minus our deductions gives us our net income, or I'll spell it out here, taxable income. Now, one of the revenue items here would be, let's call it net capital gains. So you would combine capital gains and minus out capital losses to get the net of the two. Hopefully the gain is bigger, and that extra gain is now part of the revenue here, and also included in your taxable income down here. But if you have bigger capital losses to get a net capital, not gain but loss, this loss is not here in the revenue. You cannot deduct it against other revenue items. So that's going to have an effect of increasing the taxable income as compared to the net income on your income statement. So this net capital loss amount, you still can use it by carrying it back 3 years ago, the 3 years ago tax return, or 2 years ago, or 1 year ago if you cannot use it in the previous years. Or you carry it forward to next year for the next 5 years, reducing any capital gains in those future years. But again, you cannot offset any ordinary income. Now, the net operating losses, which we'll look into right now, is talking about this figure down here as compared to this figure up here. Technically, you cannot have a negative taxable income. But if you do, that's really your net operating loss, meaning the deductions down here are bigger than the revenue up here, resulting in a negative number. Again, you cannot really have a negative taxable income, but that's really how we calculate an NOL, a net operating loss. And in past years, you could have carried it back, but not anymore under the Tax Cut and Job Act. You only can carry it forward to future years indefinitely. I believe in past rules, past years, there was a limit of years, but now it's indefinite. And you can use this NOL to offset the taxable income of those future years, I believe up to a certain percent. I think it was 80. We'll see in the next slide. Okay, so that's the difference between NOLs, net operating losses, and net capital losses. Okay, so we just finished reviewing net capital losses. Let's take a look at net operating losses. Again, like a negative taxable income number. So for now on, you only can carry forward to future years that NOL, yeah, NOL, and offset up to 80% of those future years' taxable incomes. You cannot carry back like in previous years here, 2 years, not the 3 I mentioned before, and forward for 20. Here it's just indefinitely carried forward. Let's take a look at an example here. We have XYZ, their NOL for the current year. Again, think of this like a negative taxable income is 20,000. And you cannot carry it back to a previous year, 2016 or 17. You just carry it over to 2019. And here we're told we have taxable income of 200,000. Just a mirror image of the loss in the previous year. So the question is, how much of the NOL in 2018 can we carry over and deduct in 2019? So under previous laws, you could deduct the whole thing. Under current law, up to 80% of the carryover year, or 2019 years, taxable income is the limit. So 180,000 of this 200,000 is deductible in 2019. And then the remaining 20,000 unused NOL, you carry it over to 2020, as mentioned on this slide, yeah? Sorry, it's 80% or 160,000, not 180. And the remaining is 40,000. See what happens when you don't use your calculator and try to do the math in your head. Okay, so limitation of 80%. This is something new for 2018. Let's take a look at another timing difference, another temporary difference between book and tax, and that's charitable contributions. In the case of income statement, you deduct the whole thing. Okay. In the case of taxes, there are limitations. So you're deducting most times either a cash contribution, or if it's property, capital gain property, you're deducting the value, fair market value of the property. Or if it's ordinary income property like inventory, if you sell inventory, you have ordinary income. So if you donate inventory, you're going to be deducting not the value like capital gain property, but the cost basis, the adjusted basis of the property, which is lower than probably the value. Here's a special rule in the case of accrual basis taxpayers. If you have pledged a contribution at the end of the year and it's a big amount, you would accrue it, but you cannot deduct it unless it's approved by the board, your board of directors of the corporation, and you actually pay it off within 3.5 months after your year is over. Okay, so most times, yeah, when you accrue stuff, you pay it within a couple months, but here they're making sure you pay it off, yeah, within 3.5 months after the year is over. So the limitation, the main limitation for tax purposes is that you only can deduct up to 10% of your taxable income. But that taxable income doesn't include any deduction for charitable contributions because you're trying to figure that out right now, right? Before figuring out the limitation. You also cannot deduct any dividend received deduction, which I believe is going to be the next example we'll take a look at. You cannot carry back NOLs to this year. Remember, you always can carry forward NOLs now, right? But cannot carry back, so that makes sense. This production activity deduction is not generally applicable to corporations anymore unless you're a partner, a corporation is a partner receiving a flow-through deduction. Okay, so we'll ignore that. And then again, capital losses, are able to carry back, but here you cannot carry back to reduce your taxable income, which is good because you want your taxable income to be high to get this bigger 10% amount. Okay, and then if you have any extra unused charitable contributions here, just like capital losses, you can carry it forward for 5 more years. You cannot carry it back like capital losses though. So let's look at an example where we have a charitable contribution of $700,000 for the year, and let's see, we have NOL carry forwards of 24, which is okay to deduct, and dividend received deductions of 15, which we haven't calculated yet, learned to calculate yet, but we learned just in the previous slide, you have to not deduct this to your taxable income. Okay, so the taxable income was before these two amounts here, but you can deduct this. What you cannot do is carry it back. That's no longer available, yeah? So we reduce this taxable income by 24 and take 10% of that. Here's our taxable income. Here's the NOL being carried forward, and we deduct it to reduce the taxable income. We take 10% of that, and that's the limit. Here we paid more than that. So what we get to deduct is the limit amount here for the current year. So really your taxable income is going to be this amount minus the charitable contribution, and then eventually minus the dividend received deduction. Now, the extra you paid, or this $73,700 in charitable contributions that you cannot deduct this year, you're going to carry it over to the next 5 years, subject to that same 10% taxable income limitation in those future years.